Hello and good morning, listeners. It's been a riskier month and an eventful week for the financial markets. And this is Almus Market Mornings with Shikhar Garg, bringing in all the updates on live basis. Well, folks, we have had the BOE addressing the markets yesterday, raising rates by 25 basis points and also repeating the possibility of further tightening in monetary policy if there is evidence of any persistent pressures. Japan's inflation also slowed down after 13 months ahead of the BOJ's governor transition, but needs to be seen whether it is a one off number. But what's more interesting is the market sentiments. It has been quite dramatic in the past couple of weeks, with the participants pricing in an aggressive Fed raising rates several more times to a doomed scenario after the banking stir up led to a faster rate cut expectations. And now it is to a little less doomed after the Fed meeting. So, JK, there has been wild swings in the market sentiments. What do you think of these kind of sentiments?
Yeah, good morning, Shikhar. You actually referred to the BOE rate hike. I think for me, the more significant move was by Swiss National Bank, which raised rates by 0.5%, not holding back its fight on inflation. And it is significant because they were the one who dealt with one of the major banking crises when Credit Suisse was, handed over to UBS with the efforts of the government. Anyway, it was a day for market to reassess impact of recent financial sector events and how the economy and yields will evolve over the coming weeks and months. It was also a day when investors had to digest the fresh policy rate hikes by three banks: BOE 0.25, SNB 0.5, and the Norway Central Bank by 0.25%. All of them reiterating that if more action is needed, they won't hesitate. But actually, the Bank of England governor was a bit more optimistic in saying that inflation will possibly come down in the coming months. And so markets were in a way prepared for these moves because ECB and Fed are already adopted a similar line. And I read these moves by central banks as an expression of their confidence, at least to show that they are confident of handling the current banking related issues effectively. And no panic has been displayed by them so far. So US markets did experience more volatility, reacting to statements from Yellen on not assuring blanket protection for depositors, which contradicted with what Powell had said. So while the major indices ended in the green eventually, they had given up much of their earlier strong gains. S&P was up 1.8% at one point of time, but closed only 0.3% higher. Post-Yellen statements on extending, not extending the insurance to all deposits. Although she did say that US was prepared to take additional actions. Now, there is not a reversal of negative sentiment about stocks despite the relative calmness in the banking sector, and investors actually watching if there would be further bad news from banks. And also the quarter ending is keeping things relatively quiet. Moves may be more guided by position adjustments. Disappointment from Ellen's statement also reflected in safe haven buying, and again it was yen, gold, and the yields that were on the limelight. 2 years down, again below 4 at 3.78, and a 10-year at 3.38, of climbing to 3.52 overnight. Late recovery in equities after soothing words from Janet Yellen appears to have helped stop the decline in yields, with the 10-year again lifting a bit later in the day. Now, notwithstanding dot plots indicating another rate hike possibly this year, markets are pricing in approximately 65% chances of Fed pausing at the next meeting, and only 35% chance of a 25 basis point move. As for the dollar, the underlying trend remains one of weakness, with the euro touching 1.1929 yesterday. Although the rest of the currencies only rose mildly and yen was unmoved, but there has been a reversal of this in late New York and continued into Asia, where we are seeing yen strengthening while others have given up their gains. I am putting it down to the year-end repatriation pressures from Japanese investors who need to buy back yen and sell those currencies where they are liquidating assets for profit taking. Thus, yen crosses are down, and I expect more to come in this direction in the run up to 31st March. However, against the dollar, euro should see support coming at 1.0780, GBP below 1.22. As you said, Japanese inflation headline for countrywide came down at 3.1%. But once again, It's a sharp slowing, no doubt, from 4.2. That was last month. But I think this is also due to the energy subsidy that the government has given. And if you look at the details, the services inflation have hardly, relented. And this is a sign that underlying pressures will remain. Going ahead, we have retail sales from UK. More importantly, the preliminary survey by S&P Global on the PMI of major economies. And it would be important to see how the economies have continued to perform post hefty rate hikes by the central banks in the last 1 year. Finally, on the rupee, it did perform in line with the peers yesterday for a change, strengthened by 0.7% from the previous day's close. And intraday, we had seen a gain of more than 30 paisa. Modest flows related to year-end and enhanced exporter selling was behind the move, although we did see good importer bids near 82 and expect more move to the, link to flows in the coming days in the run-up to the financial year. And dovish expectations from Fed will definitely add to some strength on the rupee. Lower importer demand already reflected in trade deficit and relatively higher premium helping the rupee, although one would keep an eye on the global developments in the banking front where things have calmed down for the time being. Thank you.
Okay, JK, that was quite good. And yes, the Swiss National Bank was a good surprise for the financial markets, raising the rates by 50 basis point and not breaking their path with all the banking concerns in their fight against the inflation. It seems that though central banks have kept major of their focus on the fight against the inflation and as well as trying to maintain the banking crisis to the limited effects as much as possible by giving it time. But all said and done, the whole banking issues will also act as a natural tightening process for the economies, putting some bit of support for the banking central banks on their fight against the inflation. What's also interesting is the energy subsidies the Japanese public found useful as the price pressures have been relatively lower, as JK mentioned, and it solves the objective of at least containing the price pressure on some of the fronts of the market. But it's the US market participants which are still having weird or a lot more volatile sentiments, with a lot many market participants pricing in a pause in the next FOMC meeting itself. So it needs to be seen how markets move ahead. That's it for today, folks. We shall end the podcast of today's with the saying, our usual saying of TGIF, and we shall come back again on Monday with another round of updates. Thank you so much for listening.